Today we're going to talk about Hyperliquid. That's potentially one of the most successful application in this cycle. And then I call it app-specific chain because when this Hyperliquid, it's both blockchain and application. When they first have the blockchain, is specifically designed for decentralized exchange. And then we'll see what we get from that and at what price. And my name is Ruizhe Jia, assistant professor at Stanford. Wait, sorry.
The Stanford thing, not the handbook.
Okay, so we're gonna have a lot of content. First, we're gonna talk about what's the context, why they do that. So beginning, actually, we don't see all of this, but really what happens is we have those crypto central exchange, and then they're quite quick, and then latency is not as good as traditional equity exchange because we're based on AWS. There is some round trip, but it's still pretty quick. But then they custody your asset, they settle trade and clear trade all by themselves. So we see FTX, they just take your money and go away. We also see cases it's just hard for them to clear the trade. And then we try to build limit order book on blockchain, but then it doesn't really work because blockchain doesn't have the throughput to support all the message of a limit order book. That's why we had AMMs and the option based on AMM. Then people are thinking about how can we build, so it's quite natural, right? Ethereum, Solana, they're all very generic blockchains. You can build pretty much everything on that. You can have a smart contract, do a lot of things. But then the people are thinking about, oh, like if you just want to do trading like NASDAQ, you need something very special data set. You need special blockchain. Then maybe we can make it quicker and make things work. So that's why they designed a whole blockchain purely support decentralized trading, and that's limit order book. They have quick speed. Their latency is quite low. And then they claim that you self-custody your asset. Basically, your asset is still on-chain. You have to sign signature to move it asset around. So, but there's another benefit of doing that. Like it's quick. Um, you have a better, potentially better infrastructure. We'll see what's the price you pay for that. But also you can design all kind of economic constraint or rules based on that. For example, Hyperliquid has a speed bump. What it really means is they prioritize cancel order and add liquidity order before taker orders, just like IEX exchange. It's a little bit different, but so really like in traditional blockchain, think about you have Ethereum proposers or like other leaders, they can decide whatever ordering they want, right? It's a very different ordering. But if you want to implement certain rules for trading, you actually want to control both infrastructure and exchange. So you actually also have the benefit of the vertical integration. So what is really Hyperliquid? There are two things. We're not going to cover Hyper EVM. We're going to cover Hypercore L1. So this is a layer one, and they're really quick. And then they pretty much have three things. They manage order book, one clearinghouse, and one Oracle. There are a few other small details, but what we really do is when trade comes in, all you care is, especially for future, you care about what is the spot price elsewhere. That's come from oracles. You care about your limit order book. That's how you match trade. You also care about people's margin. That's when you know when to liquidate people. And they're quite quick. And their vision is really, I want the same level of experience of finance, but at the same time, I want to make it on blockchain. And they're quite successful. They have 14.4 billion, around like 10 billion a day in terms of trading volume on perps. And then I was interested to you a few more things. Basically, we'll first cover the business they're doing, what is perp trading, and how lucrative that is. If you think about crypto as a whole casino, then that's the most lucrative slot machine in this big casino. And then next thing we can talk about what they built on top of that limit order book. There was something called HLP. Question? No.
Yeah. So if you go one back, can you give us a sense why they actually think that a blockchain is needed here? I mean, so what exactly what component is critical here? Is it self custody, but you can get self? I mean, what's the, you know, it's a purpose blockchain, so it's like I can't take anything beyond it. So you can only do this one thing.
Mm,
Auto.
To me,
Figure out why blockchain? Why do we need decentralization anymore?
I think let's first go, maybe after I talk about what blockchain they actually have, and then we can follow up on this question. Because you see, this blockchain is a very different animal compared to blockchain we know, like Solana, be it even Binance Smart Chain. So there's way more opacity compared to another blockchain. But when we think about blockchain, there's supposed to be transparency, but there is nothing you can verify on this blockchain. And then after that, we can talk about maybe we should think it as a Binance that posts data.
Sorry, before I get you into later, but could you just kind of at a high level, it's public, right? It's public, like it's read access to everybody.
We'll see what is public, what's not public. So like,
Fully.
so basically the whole blockchain architecture part will go on like what is really a black box, what is really more like blockchain we know. So this is not really a blockchain that kind of you think like Ethereum.
I get that. So I'm saying like let's not worry about specific comparisons to Ethereum or Solana or whatever. I'm just saying at the highest level, does everybody have read access to this thing? Does everybody have write access to this thing?
No.
On both? So
I think you have a RAID, but you don't know. Think about, I think let's talk about it later because you'll see what I mean. Like you really don't have, there's limiting you can verify. So after that, we're going to talk about like what people build on top of that limit order book. They have some fun structure going on, like called Hyperliquid Vault. And then we talk about the blockchain. So when we talk about this no exchange, we really care about this blockchain. Everyone care about how we make that happen. What's the price we pay for that, right? And then 3 and 4 will tell us. Eventually, we will have an incident and tell us how centralized this chain is and what its opacity. So we'll go through the history. And after that, there's something I really want to focus on is what's the tokenomic here. Because you see Hyperliquid adopt something really different from other project in this cycle. It's how they finance their project and their incentive completely changed. And eventually, we're going to summarize. And yeah, let's maybe after every section, we kind of answer some question. So perpetual futures. So I don't want to go into the detail of perpetual future, but what really happens is a future that never ends. So think about if you want spot trading, you really have to have the coins, right? Then how do you have more volume trading betting on the price of coins? You can have futures. Basically, the underlying is the coins. And then traditionally, we're familiar with the future that have expiration date. And in crypto, we create something called perpetual future, which never have expirations. You can have huge leverage. You can have 50, 200, 1,000 leverage. And then you can go long and short, which is basically go in the same direction of the spot or same direction of the spot delta or the opposite direction. And it never expires. So there is some mechanism for those two assets to keep track of each other if it never expires, right? Because you never have a delivery date. So, but I won't go into that. But you can think this is really, really good for gambling because you can go long or short, you can go huge leverage. And that's the target of Hyperliquid business. So what they do is they have, when they first start, they're targeting on the perpetual future business. And then their trading volume, even today, is around like 10 billion a day on perpetual futures. But what is good about perpetual future as a business is really people have leverage. And those are retail with leverage. They're not very careful, just like people buy Tesla options, 0 DTE, right? So then you have tens of liquidations. Liquidation are the best flow, right? You have uninformed flows blasting through the market, and then basically, and they're forced to sell at their exit price, like that is like basically they're wiped out at the price. So they're forced to sell when they have a lose. So eventually, just you can see uh, retail have a lot of gambling and they get liquidated and they have generate a lot of fees and market maker a lot of money from liquidations. What also happens is it's more subtle in the sense if you look at crypto spot market, for the first few levels, you normally don't trade through. So if there's market orders, normally stop at first 1 or 2 levels. But because you have huge leverage, the notional is so large, you can see a lot of trade throughs. So eventually, a market order from retail can basically trade through multiple levels. So you can basically like perpetual future is really the I would say the most lucrative product in the whole exchange business. There are a lot of retails, generate a lot of fees. They have tons of leverage, and market maker like to participate in the game because they can capture a lot of down flows and so on. Go ahead.
can you say something about why perpetual futures are so successful in crypto markets relative to traditional markets? Like
We don't have perpetual future in traditional market.
But that's my point, right? So like perpetual futures were not, invented as a concept just now. They were invented, Killer wrote about it in what, like
So
something?
think about this, right? In traditional world, we have options, and option took off after 2020 when people start gambling with a lot of options. So the whole pile size, which is how much people earn from options, went up so much after COVID. So then really like, I would say in alternative market, we need something like that. And it just in crypto market, it's such a linear product. You just have go long and short, super simple, and people just get into that. That's why in the same time, if you look at crypto options on Deribit, on Paradigm, they're mostly institutions. And for retail who are not sophisticated, maybe they just go into this. That's my theory, but I don't know if it's that's really the truth.
Barrier to entry is lower.
Yeah, we're just cognitive interest lower. Level of sophistication probably is also much lower. Also,
Retail investors.
yes, linear product, long and short.
Perpetual futures to explode there too.
I mean, I don't know because
Or what I'm getting at is like, is there something specific you think about the blockchain architecture or something?
No.
that Actually, okay, so then it's more about the investor base.
it's more about you have a ticker, people gamble around.
What's that?
If you have a ticker and people gamble around that ticker,
But that you can do that in traditional markets too, right? Like,
yeah, so that's different instrument.
right, so that's the access point, right? So yeah.
Yeah, okay. So that's why the exchange want to use alternative way to capture that lucrative business, right? What they do, they typically have internal market making teams. So if you have go to the second tier exchange, typically they have their own internal teams. Basically, they market make with better information than you have, and they capture liquidation flows and everything. They can potentially even force liquidations. That's common knowledge. And then for most people in the space. And then also they typically have a different set of APIs. So for people who are insiders, they can be very collocated next to the exchange, and then they basically are way quicker than you are. They're pretty much in the same AWS, in the same location, same server. And then if you're internal market making team, you never get liquidated, even though you made the wrong bet, and then and so on. And then there's a lot of market manipulations, and then kind of that's what happens if your whole exchange is you have this lucrative business and everything's just yourself, right? Custody, clearance, settlement, and trade. So one example for that happen is there's a big get, that's a second tier exchange. There's a ticker called Voxel, which is really like nobody have heard of that. And then so what happens is BigGet clearly have an internal market making team, and they are trying to have they're making a mistake. They basically have some patterns people can exploit, and sometimes you can even think they're cross spread. So some people figure that out, make huge amount of money, and eventually what happens is if the casino, the house keep losing money, right? They can be like, oh, you cannot get your money out, and we cancel all the trade, and then eventually you basically that's what happens in the exchange. So go ahead.
Let's go back to hospital. Why does why do crypto for high leverage?
What's that?
Why can you get such high leverage on crypto exchanges?
I mean, they give you high leverage, and then they manage margin well. Like so OKX once have huge leverage. They let people open a huge amount of Bitcoin long position, and they realize they cannot really liquidate that. Samak?
They also auto deleverage you, right? Which is something that.
Yes, that's what they learned after that. So like they realize if they take, we'll see that later, even in Hyperliquid. So basically you can see this is the most lucrative business. It's very opaque. And then that's why Hyperliquid wants to try to get in this market. Is that clear so far? We should move slightly quicker, I think. So Hyperliquid. So before we talk about the blockchain architecture of Hyperliquid, let's first talk about something fun, but this leads to a problem later. That's Hyperliquid Vault. What does it do is, really you have a vault. Slides are cutting off, so let's do this. So user can deposit money into this vault, and then the vault basically have some strategies. They can do some market making, they can capture the liquidation flow on the same platform. So they are doing what kind of internal team is doing in other exchanges, but it's fully transparent. You can see their position in real time, you can see their P&L, and eventually everything is kind of shared to people who put money here. So basically they're a version of automated market maker. Go ahead.
So is the logic like smart contract code that everybody can see? You said
No. You can't, so we'll talk about it later. Like you can't really see anything, the logic of this exchange. It's completely,
Is the trading logic, however, restricted to assets like in the chain? So, or
I mean, you can definitely trade things that don't have a data on this blockchain, right? Okay, so basically, like, they think about those people who found Hyperliquid are really successful market makers before they found that. So they have proprietary strategies, and they say like, I offer the strategy for this vault, and then
how do I even know that they're implementing? So if the strategy is
you don't know that.
invest in something else out off the chain, like even if I knew the state of the chain,
You
I wouldn't be.
it's still a vault that lock your money there, so you can guarantee.
Lock your money. You're talking about assets that are settled on that chain that
Yep.
you can see who's custodying them in on. Like, so basically, I know the state of the chain at a point in time, right?
Yes,
But if they're investing in things that are off chain,
they can't move the money out of the vault.
right? So then I'm trying to understand what you mean by like, so what can they do? Like, either they're investing on things, either they're investing in things that that are a part of the chain that are settled on the chain.
They're just making market and do trading for futures, and they capture liquidation flows.
You're bridging, let's say you're going from Ethereum to Hyperliquid.
Yeah.
Your assets are locked up on the Ethereum side. You can see that, that's open source.
It's locked on Arbitrum, pretty much.
What happens on the Hyperliquid side is within Hyperliquid.
So can I see the state of the Hyperliquid chain?
We'll see that in very quickly. I'll tell you what you can see, what you can't see. So this is the performance of Hyperliquid Vault. It's almost after a year or two, they have 500 million TVL and they generate 135 million PNL for the vault. And you can see what happens here is last Friday. Basically, think about this. They can capture liquidation flows, right? And that's 40 million profit just from that. So on the one hand, you don't know what they're doing. On the other hand, you do get money, right? So that's a cool, I mean, it's a thing on top of that. And then basically we'll see that why this leads to a problem later. Go ahead.
It's like a different thing than the perps that you've been talking about.
I mean, they're just trading on their own perp exchange.
But like, if as a user, if I go to Hyperliquid, I can either do the perps or I can choose to deposit some money in this.
Yeah,
multi-
you can just put, it's like I can trade on exchange, like equity exchange. I can also trust some hedge fund and put my money there and they do it for me.
Okay, so that I can understand the Hyperliquid perps as just like a perps protocol and this vault as like some
Yeah, it's something on top of that limit order book, on top of that chain, right? That's just really a additional service to provide. And we'll see that how that leads to a problem later.
Like an ETF.
two actors.
ETF's a bad way to say that. It's a fund, yeah.
Can you choose among different vaults? or
Yes, you can.
just-
But then it's the good thing about this vault, it can capture liquidation flow, right? Liquidation is very lucrative.
Can you also choose at least the risk of your, like, I mean, you don't know what they're doing, but they should be at least signaling you what is like how risky their strategy is.
You can observe a strategy in real time, what they do.
And you can observe. what
Yeah.
they-
And then we'll see actually quite risky sometimes. We'll see.
Do they give you a choice between multiple vaults that
They give you one vault, but you can open your own vault. So you can run a hedge fund business on top of that, right? Last question. It's HLP, Hyperliquid, HLP, Hyperliquid Provider, HLP. Anyway, so that's just a fun thing before we go into the blockchain. So the blockchain to me is 10 minutes. Okay, cool. So basically, we'll see what you can verify and what you can't. So the good thing is that you still see people sign their transaction. It's now like, trust me, password stuff, right? Like it's through blockchain, you have private key, sign stuff. And then you can see what the output, like there's transaction getting filled, order book get updated. You can see the snapshot of the whole exchange will last for a while, but then we'll see later, there are so many things you can see. And that's just gave me a lot of headache as a researcher. For example, what happens is also like, let's move quick. So when a user sends a transaction on this blockchain, what it happens is you send a transaction, send to API server that goes to gossip around this validator set. And eventually, they then send to this order book engine, and eventually you get some result. So basically, what you only know is the result. And they're nice enough to give you a version of what transaction people sign, but I don't know like if those are, hopefully those are all the transaction people sign. There's no censorship and so on. But what I really know is those transactions come into the system, and those are the order book update, those are the field, and those are the trade. I don't know anything, the logic in between. Go ahead.
Gas,
Was that?
Can you increase gas so you get your transaction?
Good question. Actually, I don't know. I don't think so. I never use, I don't think you need to use gas here. Yeah.
It's like a 1 cent. I think I saw.
Yeah, I actually don't know. So sorry for that. Yeah. Yeah.
Then, uh,
That's the next slide. Or 2 slides after this. So what gave me a headache is really like, if you don't know how they match engine, like match order and so on, they just tell me what output later. I just, sure, the result consistent with each other, right? But how about things in the middle? So that's the opacity I'm mentioning. Like you don't really know how they match order, how they execute orders. For example, in my research with my collaborator, we see that there is only one single transaction in this coming to this block called Oracle update. So the update bunch of Oracle price. And then, okay, so then why do we supposed to see trade? Like whenever you see a trade, when we see someone send a trade or something, right? But then later you can see in the block, they print out little fields or trade or order book updates. So what really happens is this triggers some liquidation. Go ahead.
I've heard people say like chain is actually permissionless, but they have like a very high like minimum staking level or something.
They give you a client, it's just bytecode, like you can't really see much.
He's using what non-validators see. So the point is like if I can put up enough capital to be a validator, I mean if I'm doing execution, I must be able to know what's
It's a closed source software, just execute them, right?
saying the code is closed source.
It's a closed source. That's the biggest difference.
Validators don't even know what they're on.
Yeah, it's a closed source software.
They run their own validation.
And yeah, they also,
One is like
some people can run their,
permissionless network.
it's a just wait a second. You'll see that.
Nice question. Right?
Okay, so just move on. There are 21 active validators. You can join validator set, but to be the person who actually make a vote and so on, you have to be the top 21 stakers. So you have to have enough money to be the person who can make a vote and update the ledger. And then you have to log for a year. So there's 21 of them. So they don't have much economic incentive for you to do the good job. Out of here, currently there's only a jailing policy, which is if you're very slow in terms of messaging rate, 200 millisecond round trip, they're gonna jail you for a while, and then you can't really pretty much participate in the consensus until you kind of say, oh, I fixed my stuff, I'm good now. So that's kind of the only incentive they have in terms of staying there. And so what really happens is like,
What is the cost of jailing?
what's it called? You're slow. Basically, the round trip is.
This is why you are jailed. But like, if I am a validator, why would I lock up my capital?
Why do you get stake reward? You get reward. Yes, but you don't get punishment most of the time. There's no slashing and so on. So you can see people sign transaction. You can see what output from this black box. You can see the book diff happening. You can every 10K block you can have a huge snapshot of all the orders happening in this blockchain. But then you really don't know they're closed source. You don't know their internal logic, and you also don't know like really how they coordinate with each other. We'll see that very quickly. And then as I never run a validator node. I always run non-validator node, so I don't really know, like, do you even have a look at the whole mempool? Because everything goes through API. I don't know, like, I never check what the APIs, like their code is and so on, right? So there's an incident to tell us how centralized the chain is. So what happens is, March 26th, someone opened later, you know, the same people, but what really happens, someone opened a position on some coin only have 10 million market cap. And then they basically open the 4.5 million short position and 5 million long positions. So their delta is a little bit positive, but not too much. The second thing they do is they self-liquidate themselves. So they basically say, I withdraw my margin, I don't have enough equity. And then what happens is liquidation, right? But this is huge positions. And we know from the previous slides, the vault will take over these positions. So now the 4.5 short is no longer my problem. It goes to the vault. Is that clear? So in the vault realized that, oh, I'm screwed. I have 4.5 million short position. The market cap is 10 million. The order book is almost empty. I cannot just market sell and get out. And then basically I'm stuck there. So what happens is people start to manipulate spot market elsewhere in on Hyperliquid it got stopped, and then they can trade on other exchanges. And then I think it's at the verge when Binance also want to list that token spot. So you can see like there are kind of between exchange strategic behavior going on. So you can see what happens is you have 4.5 million positions and the price went up 3 times, you have 12 million unrealized loss. This can make the whole vault becoming under the water at some time, right? So what they do, they say, we have a validator vault. We cancel, I don't really know what they do, but they say like, let's settle all the trade on this token at some price we think is fair. That's the first thing. And we delete this ticker completely. And then for people who are, we think are bad behaviors, they don't get their money back. But for some people we think are just retail, lose some money, we give them some compensations. So like you can see really, if you have a 21 validators, you have something that very clear in the consensus protocols. There is basically a wide range of things you can do. Thank you. So the reality is really you have 21 validators. Sure, they post data, but then they can do a lot of things. Okay, so far that's the blockchain. Oh, go ahead.
So, I mean, apparently then the security is lower, so we are almost back in the centralized world.
I think that's fair. I think we need a definition of security here. I don't know what the true, like, sure, they protect a business from failing. Maybe that's secure, but on the other hand, it's very centralized. So
I mean,
yeah.
security decentralization mostly.
Yeah, so decentralization.
Said sense they're very much centralized.
Yes, so I think the biggest innovation here is we kind of, in this cycle, nowadays we should all know blockchain is a very big spectrum. You have things very centralized, not even opaque, and two things that are completely transparent and decentralized, right? So I think that's kind of the way to think about that. I have to move quick. So the tokenomics is quite interesting. So traditionally in say we in the traditional financing, right? Like VC has to do due diligence, otherwise they invest in something bad, they never exit. The startup can die, they never go to IPO, right? So there is an incentive for them to be careful, ex ante to screen project, and make sure that an entrepreneur, if they don't do real stuff, they don't get investment. And then eventually there is some incentive after so many years of developing this market for financing. But in crypto, it's very early stage. So you invest, you can get out quite soon after you have a token, right? So this should be flipped. Normally, after you invest, you can call some hedge fund, say, I put some money in my protocol, I gave you some reward, so you can fix some usage, and then you launch a token, you bribe the exchange to get listed. It can go from 500K to $2 million if you want to list on Binance to bribe a certain person, and a few percentage of token. So really, you can see the incentive is now there. The product we really created is token, and we sell to someone else. There's no alignment of VC to screen product carefully, entrepreneur to have a long-term commitment of their product, and then that's what we create in a lot of time in this cycle. And then Hyperliquid is a little different here. They actually give user a lot of airdrops, and they actually have they're self-financed. They don't take VC money. And they have, give people incentive to actually build stuff. So even though like, we still see there is centralization and so on, but we should also look at how they finance themselves. This changed incentive completely. They help them to build product in the long term and actually do well. They don't just sell token and get out. So eventually you have a blockchain. We call it blockchain. It's quick. There's quick finality. You can verify data are consistent with whatever they give you is consistent. But then if you just try to match what you get, user's message and eventually output, there's a lot of inconsistency as I show you because I don't know the internal logic. Maybe it's just inconsistent from my view, but from their point of view, everything's consistent. But then they are, basically what they do well, second is they have aligned economics, which is better than other protocols, at least in these cycles. They have a vault, they have fear sharing, they actually like have incentive, they don't take VC money and everything. But what you lose is, for performance, you definitely lose for centralizations. And there's just the reality. And also there's opacity, which we don't really see very often in blockchain. And now we have it here. So it's a close matching engine. So you have to trust a lot of things. So the last thing I want to comment on is, really, I think we know that in this cycle, really users don't care about decentralizations. So I think this app-specific chain type of concept just stay there. We build a chain specific for some app, and they have high performance, have user experience. But then you should really know the chain here is very different from the chain we typically see, like Ethereum, Solana's. And then, but this is really like, there's no perfect solution for that. If you want performance at the technology we're so far, that kind of the really like either do this track or that track. There's nothing we can solve both things. And then tokenomic matters. So we should look at how we finance project. We should look at how we distribute profit so that we have long-term commitment and innovation in the space of cryptos. And then also the transparency, auditability of blockchain, like now like they're into the spectrum, like there's something maybe you can't even see from blockchain. You cannot verify very carefully their logic and so on. So we also see that. So at the end of the day, it's just like we have the whole history, like the trade-off between performance and decentralization. And I think Hyperliquid is still ongoing experiment. They evolve all the time. We should take a look at how maybe they have more validators instead of only have 21. Maybe they have some slushing implementation where people game the system more and more, where they kind of have more MEV stuff going on. Right now, maybe we can't observe any of that. And we also see when there are other emergencies, how they make governance decisions among those validators. So I think like it's an ongoing experiment. We should all keep an eye on that. And that's actually still a lot of big innovation in this cycle.